Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. Thank you for attending this week's review. Right now, we're about in what we call sort of week 2, week 3 of the ongoing recovery in what we call the more economically sensitive areas of the stock market. So what we're going to focus on this week is what are the factors that have been driving the nascent recovery, because we know we have a lot of work to do. So yes, it's been about 2 weeks of more favorable action in the stock prices that we own, but we have a lot of work to do. So what needs to happen going forward, and how do we expect that to broadly impact client portfolios? So that's what we're going to focus on this week. I'm going to go ahead and get started here, and I'm just going to share the presentation. And so what the title of the presentation is this week is Playing the Breakout. And there's 3 big things that we're going to focus on. One is COVID cases. We know, just based on how the portfolio has been behaving, that it's been broadly impacted by the onset of the COVID Delta variant. So the good news is that now cases are actually falling across a number of states. August 14th has proven to be that nascent date where we saw growth decelerate and now turn negative across a number of states. Number 2, manufacturing and new order data remains very strong. So remember, the economic growth scare hitting economically sensitive stocks, it's not happening. What's happening as a result? Basically a vacuum reaction to the upside for a lot of those stocks that were inappropriately punished when the reality on the ground was that things were pretty good. And lastly, breakouts are accelerating across the portfolio. We're going to go through a number of charts to show these breakouts, and then also a couple of charts where we see things that are not following the overall breakout, and how do we handle those types of situations. COVID cases, as we mentioned here, 6 states that we want to focus on, and I think it's important that where we actually see negative growth in COVID cases: Texas, Florida, Mississippi, Arizona, Missouri, and California. What's key here? Texas, Florida, California are 3 of the biggest states in the union. Texas and Florida were those earliest states. Remember, we used that 45 to 60-day window to try and understand when COVID cases would peak out. We're seeing that timeline hold true across the United States. Where we see cases still increasing are in states that were not as impacted early on. In other words, they're kind of later on in the cycle. But the good news is that the biggest states are actually on the decline. California is actually one of the later states, and they're declining. So we see the rate of change slow down here. That 7-day average of rolling cases slowed down in mid-August, as we had mentioned, that August 14th date, and now going negative. Second, September does get this reputation of being a seasonally weak period in the stock market. But as we can note here, that really it's only when the stock market is in a pre-existing downward trend when September tends to be particularly nasty. So when stock markets are in downtrends, the month of September has a historical performance of minus 2.7%. We said to ourselves, what happens when the markets are already in an uptrend, in a strong uptrend? And the good news there is that historically, for the month of September, the stock market is up around 0.3%. So overall, the press is going to go on about how September is a seasonally weak period, but a lot of that is impacted by a handful of years that had statistical extremes and is pulling those observations to the left. It's what we call sort of that fat left tail risk in statistics. And so overall, though, when we strip out those extreme tail observations, the month of September is actually pretty good, especially when you're in a pre-existing uptrend. Now, from an economic standpoint, the ISM manufacturing survey remains strong. If we were going into an economic soft patch, or even worse, a recession, you would see it first play out in the manufacturing sector, and in particular, the ISM survey. What we see here is it's at around 59.5. Now, to broadly understand how you should understand these numbers, 50 is the borderline between expansion and contraction, which is right down in this area right here. Now, that's important because even when you get a soft patch, you'll see the numbers kind of go into the low 50s. We barely even got below 60. We're at 59.5. So, and it ticked upward last month. Remember, what was the big press out there? The media going on about its fear tactics is that the economy was dramatically decelerating in August. It was actually reaccelerating. And we saw that with new orders. So new orders tends to be a leading indicator for future manufacturing activity. New orders actually continued to accelerate upward and to the right. Prices paid within the manufacturing survey have been moderating. Why is that good? Because, well, inflation, if it runs away, is not good. But two, it actually gives the Federal Reserve some time in terms of adjusting its monetary policy. Easy money, low interest rates, good economic growth, that's good for the stock market. That's good for economically sensitive stocks to rely on a steepening yield curve. Why is that? Well, because if interest rates on the short end remain low, those policy rates remain low, that fuels economic growth, which is what drives long-term interest rates. That gives a steepening yield curve, and that's good for the banks, that's good for the industrials, that's good for the energy companies and commodities. So we then ask ourselves, who benefits from rising growth and rising interest rates? Well, certainly stocks with higher earnings sensitivity. So that would be like your banks, industrials, consumer, oil, gas, commodities, businesses that have revenue tied to rising interest rates. Obviously, the banks are a big component there. We've seen that already. The banks are now starting to probe those 52-week highs. And of course, valuations should remain cheap in these areas. And after the last 2 or 3 months of a lot of the stocks that we're in going through these nasty corrections, they're dirt cheap. We see a lot of the valuations, single PE or low double-digit PE with, meanwhile, these companies are generating billions in free cash flow. So we want to identify these sectors and then understand which stocks are the leaders in each of those sectors. And we can see that here when we're trying to understand where the puck is going. These areas are already strong. Financials and materials, they've already broadly recovered. We'll see that in the tech resources chart. We'll see that in the Bank of America, Citigroup charts. Already seeing that broad recovery toward 52-week highs. We then have the barbell effect of what are the areas that are going to play that catch-up trade. Energy, communication services, consumer discretionary. We're broadly focused on 2 areas, which are consumer discretionary and energy. We think that those 2 sectors are going to play a very violent recovery and catch-up trade as the confidence level in the economic recovery continues. Add on top of that, obviously, the hurricane that hit Louisiana recently did take a number of refineries offline, albeit temporarily. It tends to be positive, believe it or not, for a lot of energy stocks. And we're seeing it play out in the oil price. We're seeing it play out in a lot of these energy shares over the last couple of days. Now, the broad long-term picture as to why we made the shift out of technology and into energy, financials, industrials, etc. It's because of the long-term cycle work that we do here at LifePro Asset Management. Every 10 years or so, you get a broad rotation in the stock market. From the 1990s, it was all about tech and biotech. Then there was a broad topping out of the technology bubble, and all that money flowed its way into the commodity space. In fact, had you been invested in the Vanguard S&P 500 ETF or Vanguard S&P 500 fund from 2000 to 2011, you lost money. But if you were overweight commodities, if you did the long-term cycle framework, you did that long-term work, and you were overweight gold, you were overweight energy, you were overweight iron ore, copper, these types of stocks, industrials, you would have dramatically outperformed the market and made a lot of money. Then what was 2011 to really the beginning of this year all about? It was about cloud computing, e-commerce, social media. Those were the areas, and we were dramatically overweight. We were over 50% of the portfolio was in those areas of the stock market. But now we had to make that tough decision. What's going to be the new rotation? And we can see here Broadly speaking, when we look at the energy shortages that are beginning to take place, when we look at where the oil price is, when we look at where copper prices is, the infrastructure cycle, the infrastructure bills that are taking place both in the US, Europe, excuse me, and in Canada, it's the commodity cycle. It's the excuse me, it's the industrial cycle. These are areas of the stock market that are entering into new long-term secular uptrends. And they're cheap. The stocks are super cheap and generating billions in free cash flow. That is where we see the value. That is where the broad rotation is taking place. And it's not just for us saying that, look at the chart. This is healthcare and tech as a percentage of global equity weight versus energy and financials. We know when it hits these statistical extremes, there tends to be that mean reversion. Which chart do you want to buy and which chart do you want to sell? We ask you that question. You make that answer. And of course, the concentration at the top of the index. Microsoft, Apple, Amazon, Alphabet, Facebook are the new cash equivalents. When people are uncertain about the market, they rush into these names and buy them blindly. Everyone we know owns them. We loved them for years, but we started to sell out of these names a couple of years ago, rotate into mid-cap technology, and then more recently sold those mid-cap tech names. Why? Because they're expensive. Everyone owns them. We want to go into areas of the market that can give us multiple turns of our investment and broadly speaking are very under-owned. This is where the risk is. So right now we're just going to go through some charts here. So the first one is crude oil. Obviously, a lot of our names are tied to the price of crude oil. And what we see here is back in May, when we bought a lot of these names, oil was trading in the high 50s, mid 50s, high 50s, got into $75. And a lot of the oil stocks that we own are actually below where we bought them at, despite the fact that oil is about $10 a barrel higher from where we bought the stocks. So what's that mean? A lot of these stocks are making billions more free cash flow than they were just a few months ago. Very important point. And despite the COVID scare, which we see taking oil from about 65 all the way down to about 62 or so, has now rebounded all the way back to $70. This is very emblematic of a chart that is resilient despite having the kitchen sink thrown at it. And as a result, we see high quality names like Canadian Natural Resources responding to the oil resiliency and breaking out. We see this reverse head and shoulders breakout to the upside. That is a very bullish technical indicator. We love the name. The stock is cheap. It sports a 4.5% dividend yield. This is the type of stock that we want to own in this environment. Natural gas, almost a decade-long consolidation. As of course, what caused it was the oversupply thanks to shale gas. But as the export markets in the US are opening up, a lot of these natural gas producers are now having access to the emerging markets, to Asia, to Europe, where natural gas prices are much higher than they are here in the US. And so you're going to start to see this revergence to the mean where Europe and Asian gas prices come down a little bit, but then US gas prices go up a lot. And that's what we're seeing. And we're seeing the individual names start to respond. Range Resources, very painful correction, going from about $17.50 a share all the way down toward 12.5. And now, just in the last week or so, that violent recovery. Remember we talked about violent recovery. Don't say to yourself, hey, I'm just going to sit out the next 2 weeks and come back in. Why? Because this is what you miss out on. This is what happens. The shorts have to cover and you miss out on a good deal of the rally. Ethereum, our favorite protocol within the cryptocurrency space, our favorite level 1 protocol. Again, that 60% drawdown in the spring, consolidated, now a broad-based breakout. As it's working through this supply of sellers that sold Ethereum down from, call it 4,300 all the way down to 1,700, you're seeing this broad formation called a cup and handle. From a technical point of view, this is a very bullish formation. We think that Ethereum has the potential to go much higher. We're watching it carefully. It's a very volatile space, which is why it's a small weight in the overall portfolio, but certainly has a lot of potential going forward. We see that playing out in the Coinbase chart. Sloppy IPO, back in April. It's been basing out ever since, trying to break out to the upside. Tech Resources, similar type of consolidation and breakout attempt here. In fact, today we got that breakout. Mid-morning, it looked like it was trying to pull back again, but then very strong finish into the close. And what we see here is that broad breakout from that base pattern. So again, this is playing out ahead of the price of copper. As copper recovers, we think that'll act as an accelerant for a company like Tech Resources. The one stock that has not been responding to this cyclical recovery so far has been GM. We're watching it carefully. One of the things that we always speak about is understanding the symptoms of the market and the symptoms of individual stocks. If the sector and the type of stock is recovering and a certain stock is not, maybe there's something wrong with the stock that we're not seeing in the fundamentals. Maybe something's playing out that underneath the surface that we can't see. We're keeping an eye on it. It's the one stock that has not broadly recovered yet. We're giving it a little bit of rope, but certainly if we see an attractive opportunity come around and GM is still stalling out, we could use that as a source of cash to fund a new investment. But that's sort of broadly how we look at these stocks when they're starting to stall out. So overall, that growth scare appears to be ending. COVID cases are coming down. Growth expectations are recovering. That's good for energy, banks, industrials, consumer stocks. That's where the portfolio is positioned in. We've seen a nice recovery over the last 2 weeks. We think this is really the first or second inning of that recovery. We have a lot of work to do, but it's a good start, and we expect that to continue going forward. So thank you to everyone for all of your business, for all of your support. And if you have any questions whatsoever, please feel free to reach out to your advisor, or you can reach out to us directly here at our offices at 888-543-3776. Thank you again, and have an absolutely fantastic long Labor Day weekend.